Welcome to Financials in 5, where you get your daily dosage of finance info within 5 minutes. Let's dive right in. If you don't like gambling but still want big returns, then stick around. We've got some exciting tips for you. These stock-picking tips are your jackpot. Get ready to dive in. Ever wondered how people seem to strike gold in the stock market? It's not just luck. Well, it all starts with selective inclinations and informed decisions. Here are the top 5 quick ways to pick the best stocks to boost your profits. Let's get started. Number 5. Tune in to what analysts are saying. Check out reputable sources like Motley Fool, CBS MarketWatch, or CNBC Pro, just to name a few. These platforms offer valuable insights. Just 2 sources are enough to cross-reference and make your own conclusions. Always verify the information. Number 4. Align your investments with your expertise. Take Jim, an oil rigger in Texas, who invests in oil companies for solid dividends and other mineral stocks. He does not make a lot of money, but is able to invest in what he can by buying partial stocks. Just $5 a day is the best way to start. An essential element to consider is dividend consistency. A company's ability to consistently pay and raise its dividends is a strong indicator of its earnings predictability and financial stability. Experts suggest looking back over the past 5 to 20 years for this consistency. Spotting dividends that continue to grow can signal that a company is stable enough to make these payments, reinforcing its attractiveness as a long-term investment. Due to compound interest, Jim would have over $10,000 within 5 years or less. Now, that's inspiring. Imagine the possibilities. Number 3. Look for a good options market if you're into trading options. Can you write calls, sell calls, and speculate your way to profits? The options market can be a goldmine if you know what you're doing. Let's talk about the price-to-earnings ratio, or PE ratio. This key tool helps you determine whether a stock is overvalued or undervalued by comparing its current price to its earnings per share. A high PE ratio may indicate overvaluation, while a lower ratio could suggest an attractive deal. But remember, context is everything. For a clearer picture, compare the PE ratio of a company with that of its industry. If a company sports a PE of 10, while its industry averages 14, you might be looking at a golden opportunity. Number 2. Think long-term. As the Honorable Warren Buffett says, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Also, do you know what all millionaires and billionaires have in common? They all participate in the stock market. Some would teach this ratio as a rule of thumb to their children. Invest 20% of your earnings in the stock market, 20% in real estate, 15% in emergency savings, and 10% towards charitable causes. Then live off 35%. This rule will obviously have to be adjusted to your personal way of living, though it is a good start to know where your money is going. Planning is key. And the number 1 tip: only invest in what you understand. So there you have it. By focusing on fundamental factors like dividend consistency, PE ratios, and earnings stability, while steering clear of value traps, you can enhance your chances of picking winning long-term stocks. Remember, investing is not just about immediate gains. It's about crafting a strategy that fosters growth over time. Stay disciplined, keep your goals in mind, and happy investing. Understanding a company's debt ratio helps gauge its financial health. By calculating total liabilities against total assets, you can assess potential value traps. Another useful measure is the current ratio, which reflects liquidity. A ratio of 4 indicates a company can cover its liabilities 4-fold. Sounds simple? It is simple. Now let's make money. A blimp full.